to the Capital Discussions Roundtable. I'm Tom Nunemaker with Jim Riggio, and today Stephen Place is joining us. Before we get started, a quick disclaimer: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. Disclaimers at the bottom of all of our web pages, so if you would like to read it in its entirety. And with that, I'll change the ball to you, Stephen, and thanks for joining us. This is the first time on the roundtable, and for folks who don't know who you are, maybe just a little intro of who you are and what you do.
Sure. Just really quick, audio, video check. Everything looking sound good?
Yep, looks great.
Awesome. Good morning, good afternoon, and good evening wherever you are in the world. My name is Stephen Place. I'm the founder and head trader at investingwithoptions.com. We cater towards slightly more than beginner to intermediate option trading education and services. So I was talking to Tom over the email, and he said most of you have been around the block when it comes to options trades. And so we're going to skip a lot of the beginning stuff. Now, it's Fake Friday today for those of you that are watching live. So markets are closed tomorrow, so I'm going to try and make this as quick as possible to get out all the information as possible, show you one very specific trading setup that will be ready to go in about a month, I think, when earnings season starts to pick up. So what we're talking about today is income trading around the earnings cycle, and this is one very specific setup. It is a post-earnings trade that uses calendars, also known as time spreads, to profit from grinding stocks that have very, very low implied volatility. Now, everything that I talk about, you should be able to take it and run with it. I do have an educational product on the back end if you do want more, and I'll talk about that at the end. But everything that we discuss should take you from 0 to 60 very, very quickly. Now I'm going to see if I can pull up, because the chat, I'm not going to be able to see any Q&A. I'm not going to be able to see any chat initially. I don't actually know where it went. So I'll figure it out in a second. All right, so I'll do a really quick brief overview. There are only three things that can change the price of an option. You have delta, you have theta, and you have vega. So with these three Greeks, that pretty much breaks any kind of option trading strategy into three kinds. And these blend together. So you have directional trading, put and call buys, spread sales, and things like that. You have income trading, and I generally refer to income trading as non-directional income trading. I actually believe that covered calls and put sales are more directionally biased than most people put on. And then you have volatility trading, things like straddle buys, put over buys, and things like that, where you're looking to profit based off of the rise in implied volatility, not necessarily price or time movement. Now, in reality, non-directional income trading is kind of a mix of all of these. Income trading basically is, you're trying to manage your directional exposure, you're trying to manage your delta until the theta kicks in, okay? There are three kinds of income trades. You have butterflies, you have calendars, and you have iron condors. Butterflies and iron condors are bearish implied volatility. Butterflies work better when there's a flattish skew, and iron condors work a little bit better when there's a steeper skew in the markets or individual stock options board that you're looking at. Calendars are tricky because, yes, they are technically bullish implied volatility. That's kind of true, because since we're dealing with different durations, we also have something called term structure risk. Okay, I'm just going to do one more audio video check to make sure I didn't accidentally close anything out. Can you guys still hear me?
Yep, you're good.
Okay, good. I have no idea where that window went. So, oh, maybe that's it right there. Okay. All right, moving on. Calendars have term structure risk, so technically you are bullish implied volatility, but there are some things that go along with individual stocks and how the implied volatility changes on different months where you can get a little bit more of an advantage, okay? And this is really cool. So you probably know already that there's a cool pairing off between income trading and directional trading. So if a market's really, really choppy and you're getting stopped out and chopped around on your directional trading positions, income trades tend to help buffer against that. My trading style is a combination of both income trading and directional trading. So I like to put on directional trades when I feel like I have an edge using charts, and then income trades tend to be more statistically biased. The strategy we're going to discuss today is actually a combination of both, and it relates around an individual stock's earnings cycle. Earnings cycle not only refers to the volatility cycle, but also to any kind of very large price movement in the individual stock. So this is an example of an earnings volatility cycle. I think this is in this is actually a very old chart of Research in Motion, back when it was RIMM. Now it's BBRY. Basically what we know is that earnings are the collision between the expectation and the reality of the fundamentals of the company, okay? And because there is often a very large disparity between expectation and reality, we have risk there. And the options market tends to start pricing in that risk, and people get scared and people start hedging, and they're concerned about, you know, speculation and things like that, where, you know, as we head into an earnings event, the implied volatility will rise. Now, after that earnings event, the demand for options, therefore the implied volatility, gets hit really, really hard, and we have something called the volatility crush. Now, a lot of earnings trades out there tend to trade the actual event. And you say, okay, you know, is the implied volatility overvalued or undervalued? Do I want to put on iron condors? Do I want to put on a time bomb butterfly, or just buy some calls and puts to speculate straight up on the direction? This is a very specific trade. This is a post-earnings announcement trade, okay? Now, what we're looking for here is we're looking for stocks where we can be bearish on the actual volatility of the stock and bullish on the implied volatility. Now, I use the term actual instead of realized volatility because, you know, realized or historical volatility, the HV reading tends to throw people off sometimes. This is a quick way to visualize it. So we have the historical volatility, that's the actual risk that has happened in the past. We have the implied volatility, and that's the perception of risk in the future as seen by the option premiums. And then the actual volatility is basically what you think, what you personally think will happen to the stock price movement in the future. I'm not one of those that believes you can put on trades strictly based off of implied volatility rank, or saying, oh, you know, the probability of profit is so high because the implied volatility is so high, so I'm going to be a net seller of options. And if you completely forget about the actual risk in a stock, you're going to be in a lot of trouble. Okay, so what we're looking for here, we're looking for stocks where the actual volatility is low. That simply means we're looking for stocks that are going to see volatility compression and or reversion. And we're also going to be looking for stocks that have low implied volatility. Okay, now we know that after an earnings event, the implied volatility, you know, it gets hit really hard, and we see that implied volatility crush. Okay, and eventually it's not that there's a bunch of option sellers, but there's simply a lack of option buyers that create a drop in the premium, therefore create a drop in the implied volatility, and that's going to be a good opportunity for calendar spreads. So where can we find these stocks? The simplest explanation I have is we're looking for stocks that have seen a very large rise in price and have seen a very big drop in implied volatility. This chart's a little bit complicated to explain, but basically it's a market cycle chart where, you know, stocks go up, then they go range bound, then they go down, then they go range bound and up. So we have accumulation, distribution, and, you know, buying and selling and so on. Within that, we have the trendiness of the stock or market, and that's the volatility, okay, the actual volatility. And then we also have the implied volatility. So what tends to happen is as a stock rallies, especially after an earnings event, the implied volatility gets crushed and it really, really goes low, right? Because nobody wants to buy puts. Nobody wants to buy protection on the stock that's rallying really, really hard on the back of really good earnings. There are specific cases in which the implied volatility of calls will actually rise because everyone's buying calls to speculate on further upside. There's a lot more speculative fervor. There's actually a cool trade with that. If you start to see the call skew get really, really steep, you sell some call 1x2s, and that's on very, very parabolic markets. Good example, GoPro from maybe 6 months ago, BABA from, maybe GoPro was 9 months ago now, and BABA from a couple months ago, where we see strong price movement to the upside. We start to see way too many people buying calls, and then you can fade that, okay? What we're looking at here is more specifically stocks that are exhibiting post-earnings announcement drift. This is simply a fancy way of saying when we see big gaps up on fundamental news, the price action tends to follow the direction of the gap. Now, I'm looking for gap ups simply because price action is different on very hard rallies versus very hard sell-offs. When you see hard sell-offs on earnings, there's the propensity to see very strong counter-trend bounces. So the actual volatility can stay very, very elevated, okay? Abnormal returns tend to drift in the direction of an earnings surprise. I'm pretty sure that was just pulled off the first sentence of Wikipedia, basically saying price action tends to follow the gap after an earnings event, okay? So here's a recent example. This is an Amazon. Amazon had not bad earnings. Amazon's a really interesting creature because they tend to spend so much on capital expenditures. You know, their bottom line looks terrible. They always, they tend to report a loss or tend to not have the best look on earnings on the surface. But if you pull out CapEx, it's actually really, really good. So actually, not this past quarter, but the quarter before, Amazon had been in a pretty decent downtrend and people were scared, and probably way too many people sold their stock in anticipation or hedging in anticipation of a bad earnings event. It turned out to be good, and the stock gapped up higher. And what tends to happen on PEAD stocks is that you see a very, very strong move and follow through on the first day. And then the second day, we see a second day move where it gets a little bit parabolic. And then maybe on the third day, you see a bit more of a squeeze higher. It depends on the market cap of the stock and the overall float available. If we see that third day, then it actually becomes much more shortable from a directional standpoint. But after we see that first and second day move, stocks tend to grind after that. They don't call it post-earnings announcement explosion. They call it post-earnings announcement drift, because once the fundamentals, once you get enough investors buying in based off of those fundamentals, nobody's left to buy. And it's not that it fades, it's that it just drifts higher. Okay, so you get a 2 to 3 week grind. What does this grind mean? We get volatility compression. We get reversion, right? We get a decline in the actual volatility of the stock. And this is where it makes sense to get bearish the actual volatility. Now we could look, iron condors or butterflies, but at this point, what tends to happen is the implied volatility gets crushed. So this is the blue line. The blue line is the implied volatility of Amazon options. And you can see how, the pink line is the actual volatility. So the pink line spikes up because there's a big gap higher in the stock. The blue line drops down because the implied volatility gets crushed. Now, after a day or two, what tends to happen is that the implied volatility will grind lower, and then it hits a gutter. There tends to be a floor on the implied volatility where not necessarily a bunch of people are buying options to hedge, but nobody's going to be selling options that cheap anymore. Okay, they're just going to back up and say, you know what, at an implied volatility of 20%, I'm not going to be selling those puts because there's too much potential downside risk relative to the premium I receive. So it hits a gutter. Now this is actually an incomplete chart because the implied volatility here is on a 30-day basis. Okay, it's looking 30 days into the future, but there's actually times in which the 30-day implied volatility stays very low, but maybe the 60-day implied volatility starts to rise because of the earnings cycle. Hopefully everyone's still with me. So when it hits the gutter, you want to get bullish implied volatility. So when calendars work, okay, you're looking for the grind and gutter. You're looking for low actual volatility. You're looking for volatility compression and reversion. And you're also looking for very low implied volatility after an earnings event. So here's an example in Amazon. Okay, this was a trade alert from my service about a month, I guess it was a month ago now. Just keep in mind, this is related to their earnings cycle. So as it stands right now, there will not be any setups available in the market because we're not in earnings season. Okay, so it's just very fortunate for you that, you know, I'm putting out this training so you can, you know, get ready and get geared and see if it works for you, see if it matches your risk tolerance and everything. And as we head into earnings season, you know, you can start to consider this kind of strategy. So here's an example in Amazon. Amazon had not bad earnings. It was not bad enough to cause the stock to gap up much higher than what the options are pricing in. That's one of the first keys. You can look at what's known as the price over strike as we head into an earnings event. We have the price of the at-the-money straddle over the strike, and that gives us the percentage, which is the expectation of risk headed into an event. If the price movement is outside or significantly outside of that expectation of risk, then that's going to be one of the first things to look at. Okay. Now the trade setup I like here is actually slightly bearish income calendars, and more specifically, shorting around, you know, in terms of duration, a 60-90 calendar works, in my opinion, the best because it gives you enough wiggle room, and you don't have enough of short gamma exposure where if the stock really does explode higher, you know, you're going to be in a pretty good position. On top of that, you know, if you think about it, 90 days is 3 months from now, right? 3 months is about a quarter, and sometimes the ideal situation is the long option of your calendar also includes the next earnings event. And this is important when it comes to term structure risk, because with calendars, and I don't have this visualized, but basically calendars are bearish implied volatility on the near term and bullish implied volatility on the long term options. So if you can get a long option that includes the earnings risk, that implied volatility won't get hit as hard. It will be much less sensitive in the near term, okay? The other thing that is really, really important here is just to assume that you're going to be wrong initially, okay? Scaling in is a very good idea right here. This is not a fire and forget kind of trade. This is one where, you know, you put on slightly bearish put calendars. If the stock squeezes, which it probably will, squeezes higher, then you add some more put calendars, and then I do a 3-tier structure because if most of the time any kind of further upside action will be encompassed by 3 calendars. Hopefully that makes sense. So here's what it looked like initially. Buying to open the March-April 360 put calendar for a debit of $3.60. The ideal situation here is for the premium in March to get hit, for the implied volatility in March to go lower, and for the implied volatility in April to stay up. Now in this particular case, it didn't happen. Okay, the April implied volatility did not stay up as much as I had preferred, and so the profits weren't that great. It was still a profitable trade, and it's still a high odds trade, but it wasn't a knock them out of the park kind of trade. In hindsight, it may have been a better idea to go to April, May. It would have stuck me in the trade a little bit longer, or maybe do March, May, because the May options, I'm pretty sure, include the the earnings risk going into next quarter. So what happens here? Amazon squeezes higher. We'll actually go to a chart of today. Okay, this is what happened over the next few weeks. Amazon rallied from 360 all the way up to 385. Pretty decent move in Amazon, right? So as the stock rallies, add to the trade. So the stock rallied from 360 and change up to 378. So this is a scaling calendar, which means you add to the trade. So buy to open the March, April 375 put calendar for $4.23. Now notice how the prices are starting to increase, okay? The original calendar was for 360, and that was pretty much the same distance between the strike and the underlying as the ad was. And that's a function of the March premiums getting hits and the April premiums staying up, and it makes the trade a little bit more expensive to be in. Now, the stock continued to rally, and what tends to happen on these is if you have to add a third calendar, that means the stock has really, really moved, and that's when you start questioning life itself and saying, maybe I'm completely and devastatingly wrong on this position. Maybe the stock is just going to go up huge. Maybe it's going to get bought out, and I'm going to get blown out. One of the things you have to understand is to add fundamental filters to this kind of trade. Okay, so don't do low float stocks, don't do small cap stocks. High beta NASDAQ stocks tend to work the best here for this kind of trade. You know, Apple, Google, Netflix, Amazon, maybe Priceline if the liquidity is there. Those kinds of ideas, okay, have, at least for me personally, been working very well. So Amazon continued to squeeze, and it rallied all the way up to 380, about 385, 382. Third trade was to buy to open the March, April 390 put calendar. Now, this was actually higher relative to the price, and that's because Amazon really squeezed and then pulled back, and I used that as an opportunity to add my third round of calendars. Now, the question you may have is, well, what happens if the stock continues to squeeze? Well, there's a fourth adjustment where you go out a month further than your short options, and then you just buy some call spreads. Going further out like that, call spreads don't have a ton of time decay risk, and they can be basically a pure delta hedge. So I just, upside hedge using call spreads if I need it, okay? So the third ad here, buy to open the March, April 390 put calendar at 438. Eventually, Amazon settled into a range. Eventually, Amazon pulled back. And what happens here is that the what you'll see on basically every single equity options board right now is that the implied volatility on near-term options goes to much lower values relative to longer dated options. In my opinion, what's happening here is that everyone and their mother is chasing theta, and they're selling those options, and the institutions that need to hedge aren't going to go with options that expire in 2 weeks. They're going to go longer out in time if they absolutely need a hedge, okay? So the term structure gets a little bit more in your favor. The outcome here was selling to close the 360 at a slight loss, and then selling to close the 375 and 390 at a gain. Total return on maximum risk, also return on capital, is 11%, okay? I'm going to try and find, because I don't know where it went. This is saying it's shared. Maybe, Tom, can you, are there any questions right now? I can't seem to find the WebEx window. It kind of disappeared on me.
If you put your mouse on
is that it?
You should see a thing pop down, and there's a chat on there. But the only question is, it starts next week with AA.
Yeah, okay. I don't believe that Alcoa really kicks off earnings anymore, but yeah, technically it does. Yes, okay. So earnings season does start a little bit faster than I thought. Okay, I'm going to keep going, and if there are any more questions, I'll just ask for them. Live webinar software always screws me up. It doesn't matter which platform it is. Okay, here's another example. This is in Netflix. So Netflix had not bad earnings. The movement after earnings was, I'm pretty sure it was twice as much as what the options were pricing into the event. Okay, so that's one of the big things you want to see. Remember, we're looking at gap ups, not gap downs or gaps down, because big gaps down tend to have snapback rallies, which can be a little bit more tricky to trade. What tends to happen with very strong moves to the upside on earnings is that we see drift afterwards. So it can continue higher, but we rarely see a resurgence in momentum after those first few days. Okay, that's the cool thing about this. Now, this particular example was a knock them out of the park kind of example. I'm pretty sure because the back month options ended up, oh, there's a little chat button. There it is. Okay. That's cool. All right, I figured it out. The back month options included the earnings risk. So this is a 420 put calendar. So Netflix on its second day was trading around 428, so slightly bearish put calendar, buying to open the 420 put calendar at a debit of $5.50. Okay, you know, it's got two months to expiration on the short option. We're not trying to hold it all the way to options expiration. We're trying to pull 20 to 25% out of our capital and then get out of the trade. Okay, buy to open the 420 put calendar at 550, right? Netflix continued to squeeze, add the 450 put calendar at 540. Now what happened here, I'm pretty sure Netflix saw some reversion or it saw some pullback. What was really cool about this is that the short dated options really got hit, and the term structure was very advantageous to this trade. Now, I don't have the follow-up risk profile for this, but I sent a trade alert out selling to close, not selling to open, selling to close the 420 calendar at 610, selling to close the 450 calendar at 710. Total return on capital, 20%. Now, if I just held this like 2 hours longer, the term structure really flipped and it actually became a very, very big winner for some people. I didn't get it, but this is one of those advantages to trying to get the term structure exactly right. Here's what I mean by this. So let's say, earnings comes around, you got the front month options, you got next month options, and then the month after that. Let's just say front month's about 30 days away, next month 60, month after that's 90. I'm not including weekly options. Technically, you could include weekly options if you wanted to, okay? What tends to happen after an earnings event, if the earnings are in the next month's options, the implied volatility will tend to stay up pretty high. And the term structure really starts to work in your favor. Remember, when you're doing time spreads, the near-term options, your short volatility, short implied volatility, and the longer dated options, your long implied volatility. So calendars, again, they're technically a bullish implied volatility trade. But it's, you got to worry about weighted vega and things like that. Now, if earnings are a full-blown quarter away, you may want to go a month after that and maybe do a 30-90 or a 60-90 call calendar, put calendar rather. Okay. Remember, term structure is sort of the last mile of thinking right here, and being the volatility and the implied volatility is also kind of the last mile. What really matters here is the actual volatility. So if we go back to our example in Netflix, this is a short gamma trade. Short gamma basically means short actual volatility. You don't want the stock to see massive, massive one-directional movements without any kind of pullback, okay? And putting on this trade on a stock that is seeing a massive gap up after earnings, right? That's going to provide you with the kind of pattern, the kind of stock that will allow you to get short realized, short actual volatility without getting into a whole lot of trouble. And again, not putting full-blown risk on all at once, not doing a set and forget kind of trade, but slowly scaling into the trade, slowly adding risk as the stock moves is going to be one of the better ways to manage your risk in this particular trade. Okay. Matthew is asking, how soon after earnings do you initiate the trade? This really depends on how much the stock moves. So ideally, if we see a big gap up in the stock and then it sees a massive second day move, I'm okay with adding, or I'm okay with initiating right there. So almost 3 days after earnings. I don't do it the day after earnings because there tends to be follow-through momentum the next day if it really wants to move. So I wait for the follow-through momentum, then that's where I get involved. If the stock doesn't move a whole lot after earnings, it's possible that it starts to fill the gap. That's a different setup. You're looking for parabolic moves, right? You're looking for basically holy crap to the upside moves 2 or 3 days after the earnings event, and that's going to give you kind of the best scenario. Now, could you go a little further out after earnings? Yeah, it's possible, but I haven't tested that and I haven't worked with that kind of trade before. David's asking, how do you personally measure weighted vega in this case? I don't really, again, I don't care about it that much. What you can potentially do is you can see where the very, very lowest implied volatility readings are, on a 30-day basis or maybe a 60-day basis. And then you can say, all right, let me stress test this calendar and what happens if the back month options decline by 5% and the front month options, just assume they stay the same. It won't happen, but, you can look at that. So I don't, in terms of measuring it, I just look at the individual contracts and I try and eyeball where the gutter is in the implied volatility readings and say, okay, that's basically as low as it can possibly go. Okay. So that's basically all I've got. You can use this as a starting point just to kind of do a quick refresher. Big gaps up after earnings, slightly bearish put calendars, either, ideally you want 60-90, okay? So 60 days to expiration, around there on the short option, 90 days to expiration. If you can get that long option to include the earnings cycle, that's even better. You're looking for stocks that are about to exhibit post-earnings announcement drift. So you put on some calendars as it drifts higher, then you add to the calendars, ideally a 3-tier structure. If you absolutely must hedge, you can go a little bit longer out, buy some call spreads to hedge. So hopefully all that makes sense. So you can take it and run with it from there. I do have a calendar course for anyone that's interested. This is an advanced class, so if you don't know what a call and put is, this is not right for you. If you go to investingwithoptions.com/calendar, it'll talk about the course and how to profit in low volatility. I specifically go over this scaling calendar trade in detail. So, I wanted to make this quick because it's Fake Friday. Hopefully I didn't throw too many people off talking too fast. If you have any questions, if you want me to go back with a couple examples, with the past 2 examples, just use the chat box if there are any follow-up questions for this.
Hey, I think an example is always worth seeing.
Say that one more time.
I think it's always good to show examples if you could step through one, like if you have maybe option viewer, thinkorswim or something, if you can go back through time and how you do one of these trades.
I mean, the best thing I can do right now, because I'm sure if I pull up thinkorswim now, it's going to crash everything. But what I can do, I can go to my site and just try and pull up some other examples as well. I'll show you one that didn't work. How about that? That might work. A good example is in Boeing. And this is going to be hard to see. Hopefully you can see this. So Boeing had a really strong run, big gap up on earnings, and it actually saw strong parabolic movement. So the initial trade, buy to open the March-April 140 put calendar for 80 cents. Boeing continued to squeeze from there. It was actually at a pretty decent profit, but I held. Okay, I added rather buying the 150 put calendar at 93 cents. It gives you a really nice area of profitability, but what happened here is that the long option did not include the earnings cycle, and so it did not work. Okay, and I go through a whole explanation of possible adjustments and things you could look at, but it ended up being, I don't remember the actual percentage loss, but it was around 15%. So that one was actually a pretty ugly trade, all things considered. Let me see if I can find some older examples. So this one was from not last quarter, but 2 quarters ago. And this is Celgene. Celgene had a very strong move to the upside on earnings back during the fourth quarter. So the Celgene December, January 100 put counter for $1.05. If Celgene continues to squeeze higher, you add to the trade, and the alert was for the 105 put counter at $1.25. You can see how the cost of the counter continues to rise as time goes on because the short options decay a little bit faster. And then, pulling 15% out here and just moving on with the trade. So, it's a pretty reliable trade. It's one where it's not something you're going to be able to put a system on very easily. It does require a little bit more discretion, and it is kind of a very specific, incredibly specific scenario with respect to, not every single stock in the world is going to gap up after earnings, but those that do, this is going to be a good way to play it. All right, and that's all I've got for now. If there are any last minute questions, let me know in the chat. I don't know if we're supposed to run an hour or 45 minutes.
About an hour, but you can definitely end early. Do you have like a rough feel of what kind of win percent you have on these types of trades?
I've been putting them on. This is a relatively new set of strategies for me. So, and the best way for me to explain win percentage is just the stuff that I've sent out on trade alerts through my service. And I think we've had, on all the ones we've done with this particular strategy, 2 losing trades, maximum drawdown on each trade is about 15 to 20%. I don't have the trade statistics for this individually. For me, it's difficult to back test this trade simply because, you're not going to do it every single month. So, it's one of those that's a little bit more of a discretionary strategy. So, take it what you will.
Sure. Jim, do you have any questions?
No, I like the concept of the trade. I think a couple of things. Number one, that after you have that level of a move, I like the concept of waiting 3 days. You need to end up seeing, because many times you'll end up getting gaps and it'll end up moving back, or it'll gap even further. So it's kind of like seeking, its new level. So you're giving it a few days to find it. The fact that the implied volatility, does come out of the front month, but when it moves so much, not as much of the implied volatility comes out in the shorter term stuff compared to the longer term structure. So therefore you're selling higher volatility. So when I think about from a theoretical point of view, the way the trade is set up, it does have very positive characteristics.
Yeah, and it's one of those where, I think with a lot of short actual volatility trades, so, iron condors and butterflies and calendars and everything like that, where, if the range in a stock is super obvious, the stock's probably going to move and you're going to get hit. When, the best time to put on, or one of the best times to put on short gamma trades is where the range isn't obvious and it looks like the market has broken, and that's, in my opinion, one of the better opportunities out there. So, when you're dealing with upside movement, a strong upside movement into earnings, you don't really tend to see massive gaps, after the first 3 days. A lot of the news starts to get efficiently priced in, and the volume declines and the volatility declines. On strong sell-offs, that's not necessarily the case. When stocks get really oversold, you see those strong bounces and it's not as fun. Okay, so this is one where I'm looking for drift, I'm looking for grind, I'm looking for volatility compression, and that tends to happen, about a week after earnings on big gaps higher. Ethan's asking, what are the guidelines to exit the trade? My profit target's around, 15 to 25%. You can try. There are instances where it makes sense to try and milk the trade. You managing your gamma and theta basically. But that's basically the first target. If I'm hitting 20% of max risk, then I'm looking to bail. and there are instances in which the upside risk becomes, pretty darn big, and that's where it makes sense to add on that extra call spread as a hedge. Hopefully that makes sense.
Yeah, no, it definitely does. One of the things that I like, and we've talked about this, in our community, the days of options being mispriced and just being able to sell iron condors every single month, they're long behind us at this point. You need to start with an investing premise. What's your premise here? And the fact that you've noticed movement, and here's the whole thing. Your edge, so to speak, is that you've noticed movement that happens after a week has passed when stocks have announced good earnings and they've had a big gap up. The fact that the vols are going to end up remaining a little bit higher, right? Obviously, they get absolutely crushed when, the announcement comes out and it's exactly as expected, and then it's back to business as normal. When the market ends up dropping significantly, or the stock price drops significantly afterwards, depending on the news, many times it's bad news, but they're not sure. Is there another shoe to drop? Okay, are there any other issues? So there's still usually more uncertainty when the market ends up dropping. Others come in, as you had mentioned before. Other big institutions might come in because they think it's a great buying opportunity because they do have a long-term bullish view. Yeah. But when things move up, if an institution's going to take its profits, they're going to start taking them relatively soon. Yes, the bigger institutions will take a few days to end up dumping their shares, but it's going to happen relatively, within the first few days. It's not like after good news, all of a sudden they end up coming out in terms of earnings. Companies come out with, big plans to end up making things better, or they come out and announce, horrible things, whereas when you end up having bad news, they might come out a few days later and say, oh my God, we have to end up cutting workforce, or we have to end up doing, taking drastic actions. That doesn't happen when things are going well. So your investing premise, I think, is well thought out. And then once you end up having that well thought out investment premise where you do have a reasonably educated guess of what's going to happen with the forward volatility. And I thought that chart, if you put that chart up again for just 1 second, with the arrows, I thought that was very, very insightful. Yeah. For folks, the one in the very beginning, okay, where you had the arrows going left and right, because when you end up putting on a trade, basically what you're doing is that you're saying, hey, I think that volatility is going to end up being either more or less than what the market says. I think it was even... it was after that. It was the one where you had the arrows left and right and then the actual volatility on the bottom. Historical volatility.
Yeah, I got you. That one, yeah.
Because what ends up happening here, think about this. And there was a great chart. For those of you that had read Larry McMillan's Options and Strategic Investments, one of the things that he showed was taking a look, and he measured month by month by month. Here's what the implied volatility for, September was at the beginning of the month. At the end of the month, here's what September actually was. Because if you're putting on a trade, you're saying, hey, I think volatility or direction is going to be higher or lower than the market thinks. And here, the trade is you had a real premise here. You thought that the volatility, okay, in terms of the term structure, front month and back month, was going to end up being overpriced for how much it was actually going to end up moving. Plus, you also ended up making a bet that the term structure would come flatter, okay, over time, which were both very reasonable things to end up looking at in terms of after earnings when there was a big gap up. Very important that you end up looking at it, right? So it's a very specific situation. I think that this is the type of trade where you have specific, research or experience, and then you end up making a probability bet on that is the way that you can still end up maintaining edge in the market these days. Because the the quants and the algos have taken so much of the other stuff out.
Well, let's discuss philosophy a little bit here since we got time. And I don't tend to vent about this to a lot of people because most people wouldn't get it. I think a lot of the options market has become really, really inbred, where with the introduction of weekly options, all the liquidity, all the speculation is being front-loaded into short-term options. And it's also being loaded into the same 20 stocks. That's, where you say options are not as mispriced as often, I would actually disagree because it would depend on which options we're looking at.
Fair enough.
If you go with longer dated options, if institutions really, really need to hedge, unless there's like a near-term market moving event that's coming up, my guess is they're not going to buy puts that have 7 days to expiration. So there actually is still a market need for net option sellers. Now, I do agree with you with respect to, you can't just blindly throw on iron condors anymore because you have to look at what the actual market is doing. And I know a lot of, pure statistically based income traders aren't fans of technical analysis. But, if you're looking at a chart and the Bollinger Bands are compressing and the stock hasn't gone anywhere for a while, it's probably not the best time to get short gamma.
No.
The stock's probably going or the market's probably going to make a move. There's in my opinion, one of the best times to put on iron condors in the S&P is when it moves above the second standard deviation Bollinger Band, right? Because iron condors, because of the skew, tend to start net short, and that's going to give you the best kind of, starting position. So yeah, taking into account what you personally think will happen to the market in the near term, and then seeing if the options market aligns with your opinion. If it doesn't align, then that's where your edge is going to lie. If you think that the options market's overpricing, you're a net option seller. If you think it's underpricing, go buy some options. And I think that's a much better outlook to have than just trying to blindly chase premium, for the sake of chasing premium. There are a lot of people I know who said, oh, look at the probability of profit on selling these puts in RIG or USO, during the big correction in oil 6 months ago. People were selling puts just because the implied volatility was really, really high without any consideration to the fact that
why
markets were in a downtrend,
Without any consideration of why.
Yeah.
It's that high, there's a reason. Okay.
Yeah.
One of the things that ends up happening is that couple of things. Over the last couple of months, at one point, and we're still relatively high at this point, not quite as high, but when we measure the steepness of the put skew in the index options. Yeah. And we were at a 3 standard deviation move in terms of how steep the put skews were, which meant that the market, the smarter money or the bigger money, if you will, they weren't worried about small pullbacks. They were worried what happens if the shit hits the fan, because they were buying puts well below the market compared to how much they were at the market. The other thing that ended up coming is that the term structure got expensive. When you take a look at the historical difference between how expensive or how implied volatility was 1 month out, 2 months out, 3 months out, the further you went out, the more expensive things got. Had one client, from an institutional point of view, they were like, oh, we should be buying put leaps right now because the VIX is low. I'm like, but the VIX is a 30-day option. Yeah, so we should be buying leaps. I mean, that's like saying, well, because apples are on sale, I should buy oranges. One has relatively nothing to do with the other. It really, you have to end up looking at the specific stuff of what you're looking at. And that is something that a lot of people don't end up looking at. And it's a bit of a pet peeve because you have to know that if you're buying a spread. When you walked through, Stephen, about how the calendars got more expensive, okay, as time went by. That's a really good example of understanding the difference in how the front month decays versus the back month decays. And you could see that in terms of it. And just because it's more expensive doesn't mean that it's a bad trade. It's part of a system, and you're playing it in such a way. And that was, that was a very pragmatic way of looking at how to end up running a trade.
Oh, cool. Just since you talked about the term structure of the market and how people are like, oh, I'll buy puts because the VIX is cheap. One of the cool things, first off, everyone, there's only like 3 people that really understand how to trade the VIX, or the VXX rather. Everyone else just screws it up, right? But, one of the cool timing indicators that I use is what I call a buy the blood signal. And I'll just pull it up really quick. This is a chart of the VIX relative to VXV. And this just shows us the demand for options on a 30-day basis relative to options on a 90-day basis. And normally, the options near term have much less implied volatility because, we know a lot more that's going to happen in a month versus 3 months. But when we see this flip, when we see the value of the VIX, the demand for 30-day options become higher than the demand for 90-day options, it means that on a very large scale, investors are saying, oh shit, I got to hedge right now because something bad is happening. And what tends to happen is when the VIX becomes higher than the VXV, you could also look at VIX futures, and when it backwardates instead of going into contango, that's a buy the blood signal. And that's the time to get a little bit more aggressive to the long side, because you now have enough investors that are getting overhedged and underexposed to the market on a short-term basis, where if you get enough people doing that, the selling is going to stop because there's no one left to sell. So, this is one of those where context matters. Context matters a lot. So I think that's a pretty cool kind of setup too.
2 questions. Do you have similar charts where you're looking at this in terms of futures 1 month versus another, and take a look at the contango versus backwardation on a 2 month versus 3 month, 3 month versus 4 month type of chart? That's one of the things I look at.
One thing you could probably look at, if you've never heard of VIXCentral.com, this is a pretty cool source for data. You could also technically look at VXST, which is the demand for short-term S&P options. One of the other ones that I look at is RVX relative to the VIX. So RVX is the Russell 2000 VIX, okay, volatility index, and the VIX is the S&P volatility index. And what tends to happen, I'll just pull it up really quick, is when the RVX relative to VX, or the RVX relative to VIX, when that gets too low, it tends to be a point in time in which it's basically a complacency thing, where there aren't enough people buying puts in small caps, probably because the small cap market's running really, really hot, and way too many people get complacent. So that could be a bearish signal. If you go to VIX Central, this is really cool because it shows you the near term. Actually, it shows you all VIX futures, shows you VIX futures relative to spot. And this is basically the site I go to whenever anyone says, I want to get long VXX or UVXY or TVIX or whatever. I say, all right, do you know, what's the steepness of the VIX curve right now? So this is a quick and dirty way to look at it. There's a lot of volume here, so this actually technically could be a more pure kind of risk measurement than looking at the implied volatility on the S&P now, simply because there's a lot of people here. And you can go to historical prices. You can actually look at contango, and this is really cool, where if you look at, for example, 1 month, 2 month contango, anytime it gets underneath, the 0 line, that tends to be a pretty good buy signal in the markets. You could also look at, what's that, 4 month versus 7 month, or, you could compare it to spot, or, whatever. So this is a pretty neat tool if you've never seen it either. So John's saying, I've been marveling at how bullish the VX term structure, the VIX term structure continues to be. My guess is we've got earnings season up on deck. If you want to hedge as an institution against any actual stock, you're probably a little bit more skittish about earnings. So you're going to be buying protection in May options, and April is going to continue to get hit. Simply because there's, we know what's going to happen in 30 days a little bit better than what we do as we head into earnings season. So Mark is asking, is there a way to trade the RVX versus the VIX? No. RVX and VIX are statistics. So you can't technically trade the VIX. You can trade volatility derivatives, but the VIX is just a measurement. It's like looking at the tick or looking at the NYSE advanced decline line or the summation index. Those are just breadth indicators or internal measurements where you can't actually trade those, but they might actually help you get better signals on the individual markets. So hopefully that helps.
Thank you.
Yeah, really good discussion.
Very cool. Any more questions about anything we've talked about? Looking around.
Doesn't look like it.
Okay, very cool. Well, hopefully everyone got a lot out of this. Mark's saying, can we trade futures? I could spend an entire extra hour talking about how to trade, volatility stuff. So you're saying, can we trade futures? Sure, you can trade volatility futures, but volatility futures are not based off of the spot VIX. There are instances in which the VIX will rise, but the near-term VIX future will not, or maybe not rise as fast because it's already priced into the VIX future, okay? There's a lot of moving parts here, and it's a lot more difficult to get pure VIX exposure than you think. The thing that I tell people when they say, oh, I want to get long VIX calls or VIX call spreads or VIX futures, I'm like, what you're really doing here is you're looking at a chart of the VIX and you're saying, oh, look, a VIX at 14, that means I need to buy the VIX, but you can't actually do that. What you're trying to do is top tick the market, and if you're going to do that, you might as well just sack it up and buy some puts on the S&P, because that's what you really want to do, but you've tried to time the top about 15 different times over the past 2 years, and that's the reason why you're looking at the VIX, because you say, oh, it's such obvious support, but it's a statistic. You can't actually do that. If the VIX is at 13, the VIX future is probably already at 15. So you're not going to get the amazing deal like you would think. Okay, Mark, I get it now. Okay, you're saying like, could you technically trade VIX versus, so VX futures versus Russell volatility futures? Okay, that makes more sense. I'm not even sure that the Russell volatility has futures. There may be a spread opportunity there. I'm not sure. One of the things that I see institutional traders do is that they trade VIX futures flatteners, okay, where, if you want to get bearish on the market and maybe you want to take a little volatility bet, you go out here, and I'll zoom in, and maybe you buy the April VX contract at 1565, and then you sell the May at 1745, and that's a VIX curve flattener. So, it's one of those where if people finally have a reason to get scared in the near term, you'll see that short-term VIX future get bid up, and that flattener is something that makes money. You can also do the opposite when the markets are really, really panicky, and you can look for the vol markets to go back in contango. So that's one way to trade it. I'm not entirely sure about Russell vol futures. If they exist, they're probably not that liquid to begin with. That's outside of my wheelhouse, though. So.
With that, we're at an hour, so this is probably a good place to stop. So, Stephen, thanks very much for coming by and presenting that. Really appreciate your time.
Thanks for having me.
Thank you very much, Stephen. Have a good night, everyone.
Thanks, Jim.
And a good Easter, everyone.